Hey, welcome guys. I wanted to make a video because I got this article sent to me a few times that was written last week by Tim Cestnick in the Globe and Mail. And I thought it was great. It talks about how Tim is selling life insurance, but really there was a lot of traction from a lot of advisors. So I thought what I'd do is I'd walk you through this article and then actually show you how we would go about building this for it. So here's how to sell life insurance like Tim Cesnick. So if you have read this article, you'll understand he's just talking about how he helped one of his business owner clients use a life insurance policy to generate some additional income in retirement. So here, if you come down to the mechanics section, and I'll attach this article to this video as well. But what you saw is this business owner was 46 years old. He hadn't saved a whole lot of money for retirement. So he said, hey, you know what? Let me just start doing this with a life insurance policy. And so what they did is they looked at putting a $50,000 insurance premium policy together, and he was going to pay it for 10 years, and then it was going to be paid up. And then he was going to let it grow. And then at age 65, he was going to start accessing that money. And the question was, how much could he get? And so what Tim said in the article was that he could get about $44,000 a year for 30 years. And the way that he was going to do that, he was just going to take his par policy down to the bank, show the cash value, and draw a monthly income of $36.92 each month. So this is a very common thing we do. And so I'd like to show you how we would go about doing that in our software and so on and so forth. So this is what we did. So to rebuild this, you have to understand that this policy would enforce many years ago when he was 46, I think 8 years ago. So there was a lot of changes to life insurance, but I wanted to show you what it would look like if we built it today. And actually the numbers do look better. So I was very surprised on that end. Now, in the article, they talk about a business owner who's 46 and doing a single life policy. You know, you might get some better value out of a joint last to die, but it wasn't really clear if he needed this insurance for personal reasons. And it also isn't clear if this would be a corporate policy. So I just doing everything individually. But because he wants to do a 10 pay, it makes a lot of sense to use a 10 pay product. And of course, if you've seen in my videos, you know that Canada Life does have a 10 pay product. Now, when you look at leveraging policies, really what you want is ones that have the most cash value later on, because the loan is going to be attached to as a percentage of cash value the policy has. So the policy that has more long-term cash value, the better. However, I have found real world situations that at the end of the day, you know, you might put in place a plan that makes a lot of sense for 30 years down the road, but in 5 years we have a financial crisis or a slowdown in the economy, and a business owner might need that money back. So I found that even though we look at long-term values, I try to build something that is a kind of the best of both worlds. And that's what you'll see our wealth product used quite frequently. But also we'll use the estate one in this place because it's going to have the most value long-term. So it really depends on what you want to do. Do you want one with the most cash value long-term to get the most benefit, or is it something you want the best of both worlds? So I built it on this product here, and you can see that we're doing our 10 pay product, the State Achiever, and we're adding in additional deposit options. So that's going to be 50,000 of total premium. And it's going to be paid up after 10 years, as you can see on this illustration. And then it keeps on growing the cash value. And the idea is he's going to access the money somewhere down here. While this is a great illustration and talks a lot about the things that I'm talking about, I think what we really need to do is we need to import it into one of our strategies. So if you have seen these strategies before, asset efficiency, you'll understand that this is the strategy that we use to show collateral loan. So what I did is I just imported this illustration in here with the same assumptions that he had. He's going to pay for 10 years. He's going to start accessing money at age 65. What does that look like in terms of income? So I'm just going to go to the main page and I'll explain this, and we're going to jump back and forth in this proposal a little bit. But here, what you see is the life insurance policy has a total commitment invested of $500,000. And so what that is that's the $50,000 of premium invested for 10 years. So the total capital is $500,000. And then the question is, how much income can we generate from this policy? And yet again, we're going to start drawing out income at age 65 for 30 years. And it does all the calculations for us. And it says that this policy will draw out over its lifetime of $1.4 million of total capital. And I'll show you what that is yearly in a second. But then at age 95, assuming he dies at that point, there'll be another death benefit after paying off that loan of $459,000. So really, the 500,000 investment is getting us about $2,000 of total capital back, some in retirement income and some in death benefit. And then if you just let that grow, it'd be $2.8 million. So the question you probably have is like, well, what is that amount yearly? So let's take a look at that. So we're gonna jump a few pages here because I just want to show you what's happening. So what we're able to do, I'm just gonna go over here. This is the insurance side. So this is starting at age 65. He's gonna be able to pull out $47,984. So that same $50,000 investment is actually able to pull out more than the article that Tim Cestnick put together. But there's some differences and so on and so forth. But I wanted to show you, like, this is how he's selling these policies, right? He's saying make a $50,000 investment every single year for 10 years. Then at age 65, we can start drawing out about $48,000 a year of tax-free income. And at the end of the day, if you died age, age 95 here, there's still going to be about $450,000 of net death benefit. So when you read that article, if you're sending it to some clients of yours going, here's a strategy that you can employ that could outdo some your other investments, or at least balance out your portfolio, but more importantly, give you tax-free income in retirement. That is the big draw on this strategy. And of course, to build an estate plan. But like I said, if you want to do a joint last to die, that would have an even bigger estate benefit later on with probably some slightly more income. So that's the one he did. But I thought, if we're going to talk about this stuff, why don't we talk about another big strategy that you probably have a lot more opportunities than a $50,000 a year premium. And for that, we have to talk about grandparents. So one of the big trends, of course, is people have amassed more capital than they need, and they're looking to, pass it on to the next generation. So buying an insurance policy for a grandchild is a big part of that. So I found that people like the 10-pay option. So especially if you have some grandparents that are in their mid 60s, they probably want to get this done by age 75. So using a 10-pay product makes a whole lot of sense. So using our 10-pay Wealth Achiever product does look really good. So this would be the discussion with the grandparents going, hey, you know what? You just had your first granddaughter, or maybe they're a year or two old. You should think about putting a policy in place for them to guarantee their lifetime insurability, give them lifetime life insurance, give them a head start in life. But the other thing is that at some point they could access the money in these policies for, if they get married or buy a house. Or what I'm going to show you is, this is pretty far out there. It's a little loopy, but it's going to help them in their retirement maybe. So here's the plan we put together. So just $5,000 a year for 10 years, same thing, right? And it's going to buy an initial death benefit, and it's going to keep on growing. After 10 years, it's fully paid up. It's a paid up policy. And then those numbers just keep on growing. So what I thought was interesting, like, let's just say they just let this thing grow and they have this lifetime death benefit. And then at age 65, they retire at that point. That $50,000 investment grows to $646,000 of cash value, even though they didn't do anything after year 10. What would it look like if we were to access that money? So I thought that was interesting. So I put that together, and we can put these together for you as well. So we're doing the exact same thing. And so what we did, and these numbers are a little crazy because we're taking it up pretty far, but I think it's a good, illustration of what long-term values can do, right? So we made a $50,000 investment into this plan, and they start to draw income out at age 65 for 30 years, and they can draw at almost $1.2 million. And then, assuming they die, I think at age 95 is what I put on there, there'd be another net death benefit of $392,000. So that's kind of crazy, right? Because if I get my calculator out here, like I have in the past, so if I go 1159, that's the amount of cash flow they're going to get, plus another 392,000. That means they're netting out $1.5 million from a $50,000 investment. That means they're multiplying their amount of income or capital 31-fold. I think that's crazy, right? I mean, this is like, I don't know if you've shown this to people. I don't even know if you need to show this, but I thought this was just kind of loopy in a good way, right? So here's what we have. At age 65, this grandchild could start taking out $38,000 a year of tax-free income for 30 years. We could do that. We can build that plan for them. Now, I don't know what $38,000 is worth in 30 years, but I know that if you made that same investment at 5%, it's only about $9,000. Now, I made some assumptions in this plan, but I think that is just crazy loopy. So that's a really interesting strategy. And just to finish off why par here, I thought it would make sense to just show you one diagram. This shows how par works in a way. So every single year you get guaranteed cash value in your plan, and then every single year since 1847, Canada Life has paid out a dividend. Now, when dividends are paid, they become vested. So that is the new ground floor, and that cannot go down if you don't make any changes to your plan. So this is another reason it gives you a lot of downside protection of moving into a plan like this. So I think that's really interesting. So if you're going to go, hey, grandparent, here is a plan that will guarantee insurability for the life of your grandchild and also has all this cash value, but at the same time, it can never go down. And the other reason that's important is if we're going to leverage these policies in the future, financial institutions love that the cash value can never go down. So another reason. So just to kind of finish off here on this video, hopefully it wasn't too long for you. Tim Cestnick wrote this great article that I think you should definitely send to some of your clients, and it shows how you can use a life insurance policy to create tax-free income in retirement. And I kind of walked you through how that would look. If you have any cases or you need help putting this together, we would love to help you out. I think there's a huge opportunity, not just on these business owner cases, but also on grandparents or anyone who's looking to build some tax-free income in retirement. This is a strategy they should look at because financial planning, estate planning, all of that gets wrapped into this one product. Okay, I'll leave you here. If you have any questions, you'll know how to reach me. Thanks so much. Okay, bye.